All right, let's talk about a real head scratcher that came out of Jio Financial's latest results. How can a company more than double its sales in a single year, but somehow end up making less money? It sounds kind of crazy, right? Well, that's the exact puzzle we're going to solve today. I mean, it just seems to defy basic logic. You'd think more money coming in the door would mean more money in the bank. But in the super fast-paced world of fintech, the real story is almost always way more complex. So let's dig in and figure this out together. And here it is, the whole paradox in one simple chart. Just look at this. On one side, you've got this incredible rocket fuel growth. Revenue is up over 100%. But then you look at the other side, and actual profit is, well, it's heading in the completely wrong direction, down 9%. How on earth is that even possible? So here's how we're going to break it all down. First, we'll tackle the financial mystery itself. Then we're going to uncover the hidden cost behind all that growth. After that, we'll try to figure out if these are healthy signs or some serious red flags. And finally, we'll wrap up with a little guide on how you can analyze other companies that are in this exact same phase. Okay, so let's dive right into this financial mystery. First things first, we gotta look at the top line numbers, which, on the surface, look absolutely fantastic. So in the third quarter, Jio Financial's revenue from operations shot up to a whopping 901 crore rupees. That is a 106% jump compared to the same time last year. And this growth wasn't just a fluke. It was powered by these huge increases in interest income from their lending and fees from payments. But, and this is a big but, then we get to the bottom line. Despite all that incredible revenue, the company's profit after tax actually fell. It went down by 9% to 269 crore rupees. So this is the heart of the puzzle. The money is definitely coming in, but it's just not sticking around as profit. So where did it all go? To find the answer to that, we have to look past the big flashy headlines and actually follow the money. And that brings us to our second section, really understanding the true cost of this kind of growth. You see, the secret to solving this paradox isn't found in what the company earned. It's actually hidden in what it spent. The story of the missing profit, it's all written right there in the expense column. And boom, here's our answer. While that revenue growth was super impressive at 106%, just look at the expenses. They absolutely skyrocketed by an astonishing 333%. That massive surge in spending didn't just eat up all the new money coming in. It completely wiped out the gains and then some. So where did all that spending go? Well, the biggest piece of the pie is something called finance costs. Okay, think of it this way. To be a lender, you first need a bunch of money to lend out, right? So JFS had to borrow a ton of money to fund its super fast expansion, and the interest it paid on that debt shot way up. On top of that, you've got operating expenses for stuff like technology and marketing also climbing as they race to get new customers in the door. Now, this isn't some accident or mistake, it's a very deliberate strategy. It's called being in investment mode. It's actually a classic playbook. You've seen it with companies like Amazon back in the day. You sacrifice profits in the short term to build a massive foundation, getting customers, building out tech, all with the belief that it's going to lead to much, much bigger profits down the road. So this leads us to what is probably the most important question of all. Is this super aggressive spending a healthy sign of a future giant in the making, or is it a red flag that a company is just burning through cash way too quickly? Let's try to interpret this strategy. Okay, on the plus side, you can't deny the growth. Their assets under management, which is really just a fancy way of saying the total amount of loans they've given out, it grew an incredible 4.5 times. They're processing way more payments, signing up tons of new investors. So yeah, the strategy to attract customers is clearly working, but on the flip side, the risks are very real. Their spending is way higher than their income right now, and if interest rates go up, their own costs could climb even higher. And maybe most importantly, when you're lending money that fast, you have to be super, super careful that you're lending it to people who can actually pay you back. So what's the final verdict from the experts? Well, according to the analyst report we looked at, this is not seen as a red flag at all. In fact, it's considered a green one for long-term health. Why? Because it's a pretty typical pattern for a newly demerged, super fast-scaling fintech company. The spending is buying real, tangible growth in all the right places. Hey, we're about to shift from what happened to what it all means for you. If you're finding this kind of deep dive useful, a really quick click on that subscribe button would be awesome, and it ensures you won't miss our next explainer. So let's turn all this analysis into a guide you can actually use. Here's how you can look at any company that's in a similar high-growth investment mode phase. The big takeaway here is you gotta learn to think like an analyst, not just a headline reader. First, for a company that's all about growth, the profit number is actually the last thing you should look at, not the first. Second, dig into those expenses. Are they spending money on foundational things like tech and getting customers, or is it just waste? Third, track the metrics that predict future profit, like user growth or total loan value. If those are looking healthy, profit will probably follow. And finally, always read what the management has to say to see if they have a clear, believable plan for turning all that growth into actual profit later on. And for Jio Financial specifically, here's what you'll want to keep an eye on. First, can they keep a healthy profit margin on each loan they give out? Second, as they get bigger, their costs should start to grow slower than their income. Third, they have to keep growing fast while making sure they aren't giving out too many bad loans. And finally, the billion-dollar question, can they actually convert that massive Jio Telecom user base into profitable financial customers? That's the whole ballgame. All right, before we wrap up, we have to do a quick but really important disclaimer. This analysis is our humble attempt to decode what's happening, and it's purely for educational purposes. This is absolutely not a buy, sell, or hold recommendation. And we seriously urge you to please consult with a professional financial advisor before you make any investment decisions. This channel is not responsible for any financial losses you might incur. If you found this explainer valuable and you want to support more deep dives just like this one, please do subscribe and let us know what you think in the comments below. That support is truly what gives us the motivation to keep creating these for you. So we end right back where we started, but now with a much clearer picture. Jio Financial Services is making a huge bet. They're sacrificing profits today for a shot at massive scale tomorrow. The question that remains for everyone, investors, analysts, the whole market, is a pretty simple one. Will that bet ultimately pay off?